Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to introduce to you the key financial statements. There are two key financial statements we use for conducting financial ratio analysis. First, income statement, also known as profit and loss account. Second, balance sheet. For accounting, we apply accrual basis for reporting. Accrual basis means revenues and expenses are recorded when the transactions occur, even though no cash flow may have occurred. So, profit shown in income statement is not the amount of cash we earn. In income statement, we have included some non-cash items as well, such as depreciation. We don't really pay for depreciation, that's why net profit is not cash. Accrual basis can better measure the profitability of a company during a specific time period, because it records the business activities based on the dates of transaction. Alright, first, let's look at the income statement. The income statement provides a financial summary of a company's operating results during a specified period. All the figures shown in the income statement are on 1-year basis. Revenue for 1 year, expenses for 1 year, and profit for 1 year. For the format of the income statement, report revenues first, then deduct any expenses for the period. If we put it as an equation, it will be net income or net loss equals revenue minus expenses. If the end result is a net income, company may have two options. Either the company pays dividends to shareholders, or to keep the net profit as retained earnings. This picture is a sample of the income statement. The operations section of the income statement reports the firm's revenues and expenses from principal operations. It starts with sales revenue. Less cost of goods sold. Cost of goods sold is the direct cost of production, such as material cost and labor cost. Then you will get gross profits. Less operating expenses. Operating expenses are the indirect cost of production, including selling expense, general and administrative expenses, lease expense, and depreciation expense. Gross profits less operating expenses, you will get the operating profits. Operating profits is also called earnings before interests and taxes, EBIT. EBIT less interest expense, you'll get EBT, earnings before taxes, or net profits before taxes. EBT less taxes, you'll get EAT, earnings after taxes or profit after taxes. EAT less preferred stock dividends, the final item is earnings available for common stockholders. Usually, we call this as net profit. At this point, company may decide how to use the net profits. Either to pay out as dividend to shareholders, or keep it as retained earnings. Next, let's look at the balance sheet. The balance sheet presents a summary of a firm's financial position at a given point in time. We just mentioned the income statement is prepared only for 1 year. But for balance sheet, it is for all years, which means it includes the records accumulated from the first year the business started until current year. Total assets equals total liabilities plus stockholders' equity. The meaning of this equation is important. For holding the assets, including inventories, receivables and fixed assets, company can generate sales. When the amount of assets increases, at the same time, liabilities and equity will increase. For buying the assets, the company may borrow money from the bank. The borrowing is a type of liabilities. The company may also issue shares to finance the company, that's the part of equity. Please take note, the transactions in balance sheet are recorded at cost price, which is the original purchase price. So, the book value of a firm may be very different from its current market value. A company's balance sheet is comprised of assets, liabilities, and equity. Assets are the things that a company owns and that have value, or something that will be received and can be measured objectively. It consists of current assets and long-term fixed assets. Current assets include the short-term items that are convertible into cash within 1 year, such as cash, accounts receivable, and inventories. Accounts receivable means the amount of money that you have not collected from the customers after selling the products. Another part, the long-term assets or fixed assets, are the items of a more permanent nature, such as property, plant and equipment. Current assets plus fixed assets, you will get the total assets. Liabilities are the money that a company owes to others, such as creditors, suppliers, tax authorities, and employees. They are the obligations that must be paid under certain conditions and time frames. Current liabilities are the short-term obligations due within 1 year, including accounts payable and short-term debt. Accounts payable are the amount of money that has to be paid to the suppliers after receiving the products from the suppliers. For the part of long-term liabilities, these are the obligations due beyond 1 year. For example, company borrowed money from the bank to purchase a property. The borrowing from bank is classified under long-term liabilities. Current liabilities plus long-term liabilities, you will get total liabilities. The stockholders' equity represents retained earnings and funds contributed by its shareholders. These include preferred stock, common stock, and retained earnings. Stockholders accept the uncertainty that comes with ownership risk, in exchange for what they hope will be a good return on their investment. Putting these together, total assets equals total liabilities plus stockholders' equity. This is a sample balance sheet of a company. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.